and tell me whether I'm deluded and need to just calm down. I always wanted, as all young men do, a better car. And they'll know if it's good because they'll see some new sprayers turn up. 4th of February, we thought we'd do a piece on finance because we're looking at the new sprayers and obviously we've got a constant replacement policy of machinery coming on. Sprayers is currently on the agenda. And do we out the sprayers we have today? Do we change to the 48 metre? Then how are we going to finance it? Cash is going to have to be dealt with, I think, within an agricultural business differently now to perhaps it has been previously. Some of it's going to be the same, but actually I think with the fact the BPS payment's gone, we've now got the IHT problems and things like that. I think we're going to have to be very mindful about where we put our money and how we spend it and how we finance it. And, you know, the attitude of whether banks want to finance things. So actually, what are the alternatives? So today, I've got Tom here from Charles and Dean, and we thought we'd go through in my thinking where we're going to do, and he's going to tell me new ways, because my way of financing might be 25 years old now. So, Tom, would you like to just introduce yourself?
Yeah, thanks, James. So I'm Tom Perkins. I own a brokerage called Charles and Dean. We're a specialist commercial finance broker, been operating for 14 years. We've done quite a lot in the agriculture industry over the last decade, especially in supporting sort of diversification projects. So always keen to try and talk about different ways in which the agriculture industry can explore funding in ways that are probably not as familiar to farming. So yeah, that's kind of why I'm here today, really.
And your office is actually just outside Stamford, isn't it?
Yeah, we're just down the road, really, just in Stamford. So, you know, rural area, and work with a lot of the local agricultural businesses in that area.
So Charles and Dean has been going 14 years, and effectively you have underwriters and you're borrowing money indirectly off other people, and then you're sorting it out with the clients being the farmer, for example. It's not just farmers you do, though, is it?
No, it's not. It's so we are a broker, so we work with about 50 plus lenders. Oh, right. So those lenders will be lenders that you'll be familiar with, high street banks, as well as a lot of non-bank funders. Yeah. Now, why that's quite important for people like you, James, is because a lot of the access to funding exists in the UK through intermediary channels only. So there's a large number of funders that exist out there that support businesses of all shapes and sizes, and especially agriculture, that their way of receiving business is only through intermediary channels, through us, through people like brokers. So there's high street banks, which obviously we're all familiar with. There's consumers and businesses, and I would imagine a lot of agricultural businesses will be familiar with those products, especially. But, you know, thinking about the way in which agriculture is evolving, it's about trying to bring to the forefront some of those sort of alternative methods that might be, in today's day and age, more suitable.
Yeah, certainly from my point of view, the ways in which I've done the finance before has either been manufacture related finance, where, for example, if I'm buying a Class Combine, Class will do the finance, for example, or JCB, which is sort of, as I understand, backed by Lombard, and Lombard obviously through NatWest. And then when I first got started, it was Highland Finance, which was actually Barclays Bank, and Peter Cottage was who helped me start PX Farms when in 2003. So my model of farming has been having pretty much everything financed in the machinery term. When I felt different periods in my career when we had money, we might have bought assets, directly without any finance, or done it on when there might have been a 1 or 2, 3 stage 0%, and I took advantage of that, which you'll probably have a view on and say it isn't quite 0%, but we can get into that. But traditionally, the idea of going to a broker wouldn't have been necessarily something I would have done, because they're normally quite well subsidised and pushed through by the machinery manufacturers who are trying to push the machine to you by using their own finance as well. But from my point of view, I've either got using up my cash flow in terms of overdraft or cash, or I look at those machinery things doing 5, 7 year or even longer. The last Challenger, I tried to do it on 10 years because I actually have a 10-year replacement policy on them. I couldn't get 10 years. I couldn't get any more than 7, actually. But the combines and things, I've often started to do some longer than when perhaps in my mind my replacement policy was going to be, because I didn't want to be in a situation where I got into a tricky year and I was almost forced into changing them or having to refinance again. So I've gone longer and then taken not the physical penalty, but the interest penalty of...
Settling early.
Yeah.
Yeah, I think as well, if your replacement cycle is what it is, but I think for a lot of businesses now, machines are getting a lot more expensive.
Yeah.
Now I was going to ask you about some of your pending thoughts around sprayers. What's your theory behind? I'm assuming the discussion around these sprayers is because it's coming to its replacement cycle this year, so that you're looking at, am I doing it, am I not doing it, what other external factors are going to create a decision here as to whether it's worth investing in these new sprayers or whether it's not. So I'd be curious to know a little bit about that, James.
I've got a 2016 trailed, I've got a 21 trailed, I've got a 2020 sprayer, and a 2017 sprayer. So in terms of replacement, if I go to 48, I really need to change them all, because they're 36s at the moment.
Yeah.
So I've got to do it in one go, or I've got to actually say, okay, the Lincolnshire farm can stay 36, Bedford, for example, can stay 36, Cambridge might stay 48.
Yeah.
And I can get the configuration of the booms on the 48 to go 36, so I can still use those sprayers that way round, but I can't use the 36s to go on the 48s because the tram lines won't be in the right place.
Right.
So do I look at actually, can I do a global deal and buy 3 self-propelleds and move to 48 because I actually need less, because obviously I'm covering more ground in hectareages per day, and then or do I have to do it in a drip feed? I've got the drivers, so we've got 5 qualified spray operators, 6 if you count me, but it's whether or not we stay down the 36 metre route or go down less machines effectively and go down the 48. And the motivation for the 48 was, if I have less tram lines, I have a greater yield.
Yeah.
Because the tyres are so wide on these big heavy sprayers to what they traditionally would have been when I ran the Batemans and things, which were a lot lighter. They were 3,000 litre, smaller setup, and they're getting 900 wide tyres. I'm starting to run more crop down. Yeah. So by default, I'm getting a greater work throughput, I'm getting greater timings, but I've got wider tram lines by default, which means you wouldn't think it's a lot, but actually when you look at the 12 metre cutter bar going up the field and you realise you've got 1.8 metre of tram line, basically allowing for the fact you think the middle is a full crop, that's actually in a percentage term, you've got nearly 15% of crop loss just within that one pass on the cutter bar. Yeah. So my motivation is actually, if I can widen the booms, and we've got the fields to do it, but actually I can reduce the crop loss.
Crop loss, yeah.
And you don't need a lot of extra crop to suddenly start making a financial difference. Yeah. The only problem is it's all theoretical and it's all fantasy money, if you know what I mean. Because I spent most of my 25-year career now constantly doing improvements, waiting for these big paydays, and I'm not sure they ever come. So we've got to be mindful of that.
So these machines then, obviously, you're looking at potentially changing the 3, so obviously it's quite a big investment. Yeah. So how does the sort of actual financial side of buying these play into your decision making as well? Obviously these are quite expensive pieces of kit, and how does that change your outlook on whether you do it or don't do it this year?
The only fly in the ointment is I bought the Challenger in the end of last season, which was an expensive purchase in terms of my annual replacement policy. Yeah. So it soaked up a third of what I would have expected to have a replacement. I need to get the values right on what I'm about to sell. So I've had some values on the things I sell, and they haven't. That's actually the truth of what's happened. They've stalled me from making a decision because the replacement value has been really quite expensive. Because not necessarily that the new machine's expensive, but my old machines have had such poor value put on them by the not the merchant. What's the word? Machinery
auctions.
No, the people you buy kit from.
Dealership.
Sorry, I couldn't think of the word. Through the dealership, it stalled my process in purchasing them. Yeah. Because I've still got some finance on some of the bits of kit, not all. So you still need to make sure, as a rule, I work on a depreciation of these bits of kit of about 13%. Yeah. That's sort of where in my mind I am. And I always put typically a 10% deposit in, and then go for a period of time, as I said, 7 years, for example. And that has historically worked quite well. And then the money that's left over when I go to sell them, is enough to put another 10% on the next one.
Yeah.
The values I've been given are less than the 10%.
Right.
Yeah.
And that's the first time that's ever happened in that
First
replacement
time, yeah.
cycle.
Yeah.
That's interesting.
So I've now either got to start selling the machinery myself to people, or I've got to find an alternative way of selling them, because it looks like the dealership actually wants to sell me the new one but doesn't actually want to buy the old one. So
do you think that perhaps changes your outlook on how long you keep your replacement cycle decision? Because obviously if you're holding them on for longer, are we finding that the depreciation is falling off a cliff at a certain point, which is why that model is now not working? Whereas if we were to bring that term length forward, so it was a shorter term, does the asset hold its value more? Will you get more back from the dealer at say 4 years rather than 6 years, for example? Which would be interesting.
It would make sense, but you've got one sprayer as a 2020 plate, so you could argue that's gone into its 5th year now.
Yes.
And that actually hasn't got the same depreciation. Some of these they're trying to depreciate at 25%.
Yeah.
So I agree with what you're saying. And if, for example, that one was very clear and that was at 13, for example, you'd say arguably I've kept them too long. There is a curve, isn't there, between, and we have our own workshop and Simon in there fixing them, but there is a curve between actually depreciation and repairs.
Certainly.
Reliability for us in sprayers, because everything's so timely with the weather, etc., is quite key.
Yeah.
And they are a really important vehicle in terms of farming. So I'm almost in a stage at the moment where I don't actually know what to do, but I do know what it's going to cost me to replace them. To buy new ones. Yeah. So I do have something to work on, and I can work on the 10% theory.
Yeah.
But there will be some finance on some of the old ones. So of course it's not just 10%, it's 10% plus the finance if it's outstanding.
That's it, yeah.
And how do I get round this in the future? The only way I can think to do it is guaranteed buyback.
Yes, I mean, yeah, certainly. I mean, I wonder whether with obviously a lot of the industry is propped up, a lot of it, by manufactured support. So if manufactured support is in the form of subsidy, it might be that we start to see manufacturers looking to control second-hand markets, therefore take more of a guaranteed future value position.
Yeah.
So we might see
that'd be interesting.
Yeah, I think that sort of product evolution might be welcomed in ag, because
Yeah.
it just means that replacement cycle piece can be a little bit more guaranteed.
In America, as I understand it, say the John Deere dealerships, for example, were doing this, weren't they? So the custom harvesters were buying the combines.
Yeah.
And one of the problems they've had is people in the last change of combines have run them for 2 years, gone to put them in, and the guaranteed buyback is greater than the sale of a new combine on the forecourt.
Yeah.
So they've caught a cold, haven't they? There's quite a lot of press about it. So there is a fear that could actually happen, and that might put people off from giving guaranteed buybacks. But there's got to become a point where people who are on expanding farms, and they're in the first cycle, but when it comes to cycle 2, if they can't get the right value, as I've just found, they're not going to buy the new machine.
Well, that's it, because you're put off by the future value. Now, it's interesting, we run a scheme it's not in agriculture, it's in construction, but it's a manufacturer nonetheless. And what they typically find is when these assets go into the second-hand market, and the free market, so to speak, the value of them are strong, but ultimately as a manufacturer, they kind of want to control that second-hand marketplace. So we've actually put a scheme in place for them whereby they are taking the residual risk as a manufacturer after 3 years.
Will they sign up to that?
Yeah, well, the manufacturer wants that machine back after 3 years.
They'll refurb it.
They'll refurb it
and put it back out.
And they'll sell it as a second-hand machine.
Back in the same country, or will they just move it somewhere else in the world?
I guess it's where the demand will be, but I think there is the demand in the UK for second-hand machines of that particular, it's a crusher, is high. So if they can bring that in, put it through their workshop and control that second-hand market, they're kind of controlling the sales cycle, which I think is quite interesting. And I wonder whether we start seeing that more in agriculture.
So start to see a bit more refurb coming out of the manufacturers. So that we're buying to crush all the cans and the plastics and the cardboard, a baler. and that's had a life with somebody else before me, and that's going to get a coat of paint and get done up. So that is the same theory.
Principally, yeah.
I'm assuming that's something actually that you could finance.
Oh, certainly, yeah. I mean, I think the misconception with a lot of finance, especially in ag, is that all the new machines heavily subsidised. It's what you see around all the shows, but actually, a lot of the more the more unique assets that are required around a farm are also fundable. Used equipment.
It doesn't matter if it's second hand.
Not at all. Not at all.
Is there an age where it tails off?
To be honest with you, the opinion on when it comes to asset finance, as long as there is a working life left in that machine, it's fundable.
Yeah, and if I go and buy off another farmer, is that a problem, or is it easier to get it because I got it from another manufacturer?
It's buying from another farmer is nowadays as easy as it would be to buy it from a manufacturer. The only thing is making sure you have proof of title. So if you're buying it from the farm, your neighbouring farmer, just making sure that he or she owns it and we can evidence that, and the passing of title is nice and clear. Then the process of doing that is not much more complicated than buying from a dealer.
Because the stigma of finance now is very different to what it was.
Yeah.
Now when you ring up to look at a machine, it's almost taken for granted that you're going to finance it. Whereas, when I first started, perhaps the attitude of finance was, that you're a poor farmer if you're having to do finance.
Yeah.
But the reality is, if you're a first generation or you're a business that wants to expand, and you've got to make these purchases on your own, actually, I can't see there's any other way through it. But I don't look at them as a negative. I look at them actually as an opportunity, as a positive to grow a business.
Certainly. I mean, I think if you look at finance in a wider application outside of agriculture, it's an enabler. It's accessing funding that you otherwise may or may not have yourself to enable you to grow and expand your business. So I think over the last sort of 5+ years, where agricultural diversification has been quite a topic of discussion. Ag diversification in whatever format that wants to be, whether that be renewable, the cost to diversify is high, and I think for a lot of agricultural businesses that is the natural anxiety of diversifying is that cost anxiety. And if accessing finance was more available, you might find that sort of barrier to entry for diversification becomes lower, which means that farmers might diversify with more confidence.
So when you talk about diversify,
in
my mind, I'm thinking farm shops, or I'm thinking offices or something like that. When you say, are you talking about like getting diggers to go set up a construction side of the business or something?
I guess, diversification could be anything, I guess, but my opinion is diversifying income streams through agricultural activities, whether that be, going down, putting PV in. Turning old farm sheds into commercial buildings that can give you some predictable income, so your income isn't just based on your core.
And you would finance PV, for example?
Oh, certainly, yeah. I mean, we've done a lot of renewable agricultural business, whether that be AD plants, PV, ground source, a lot of those sort of green energy investments that farmers often consider because they've got the land and the capability to do so, often come with quite a high entry point.
What about my shed of dreams?
Your shed of dreams.
Would you finance a shed?
Well, in a roundabout way, yes. Not as plainly as here's a load of money, go and fund your shed. What I think in agriculture is that there is a lot of value locked in assets within machinery and equipment. We've touched on your replacement cycle, but for a lot of farmers, they might fund it over 3 years, 4 years on annual payments, and then carry using the machine on for 10 years. So if there's a load of unencumbered assets across the farm, there's a lot of equipment that either has low debt against it or no debt at all. There's a lot of value there that could be extracted.
So releasing.
Correct.
Okay.
So I think what is a very
so it's not a direct for the shed.
No.
But what you might say is, okay, let's look at your asset list of vehicles.
Machines,
and actually find, hypothetically, 70% are not got any agreements on, and may have expired. But you will actually look at refinancing those, because the farmer says, look, actually, I paid it off in 3 years because it was one of those 2+1 agreements with the manufacturer. But actually, I don't have an appetite to change that within 10. So you might then look at a 5 or 7 year on that.
All we're doing is effectively understanding what the value of it is today. And again, if it goes back to the principles earlier, if it's got a working life for another 3, 4, 5 years, and there's nothing to stop us from raising finance against that using asset finance. A lot of lenders will typically look at anywhere up to 80-90% loan to value. So again, we can extract quite a lot of value out of this equipment. It's very available, quite quick to access, so it gives agricultural businesses confidence to react quite quickly to opportunities.
What would a timeline be, for example, if I rang you with a list of things? You know, are we talking 2 weeks or?
Yeah, I think the thing that takes the most time ultimately is just getting a good solid understanding of the values of the kit. So if there's a lot of kit to value,
do you go off to get it valued? Or do I have to go and get it valued?
We would take care of that. I think what the benefit, I guess, of us accessing the panel of lenders is different lenders have different opinions, if you like, on what something's worth, understandably. So let's just role play if a business wanted to borrow £200,000, a farming business, it might be that a particular lender wants 6 assets in the register to be able to give you 200k. But another lender might to get to that 200k, another lender might only want 3 of the assets because their values will be different. So you give up more or less security depending on which funder. So our job really is to do that work for you and do that legwork and present options.
Are you going to the likes of, say, Cheffins, who've got the Cambridge Machinery sale ground and asking them to give values on it, or are you going to some
independent valuers? Yeah, so I think there is a practical element to it. So we will, as a broker, go out to the market and see what things are actually selling for. But when it actually gets underwritten, lenders will typically have either an internal asset management team that will value it, or they'll go out to sort of.
So the people you contact will actually have somebody that they will use for the values.
Certainly.
Oh, interesting.
Yeah.
So you're not having to do all that work and almost guarantee, one for a better word, because the issue I just talked about, the sprayers and things in which I've got. If I'm falling foul of where my finance ends up, that would suggest that the depreciation curve has been greater than actually what it was perceived to be when I first bought them.
Indeed.
And that's where the problems start, isn't it?
Yeah, I mean, look, I think it's very difficult with when you're buying a machine today, you never know what technology enhancements happen over the course of the lifetime of that machine that cause it to depreciate a lot more aggressively than you anticipated. So it's interesting that this is the first time you've experienced this, and what does that tell us
about the marketplace,
about the market as a whole? In terms of the supply.
I don't think it's the machine has actually lost value. I think it's the attitude between what they're prepared to put it on their books for and hold on to it until someone buys it. Because I might be wrong, but I think they're going to buy it, say, let's just pretend, 30,000, but then they're going to go put it out there at 100,000 or 120,000 on their books for everyone else to buy. Yeah. So their margin is enormous. Yeah. So I think it's a lot to do with them protecting their margin more than it is about the value.
About the true
and
value.
Unfortunately, I think we've become the scapegoat of that. Because it may be people aren't necessarily buying new machines currently at the moment, because obviously there's been a bit of coverage about how many dealerships have started to close down, etc. Yeah. When you think about it though, it's a stupid thing, because of course what they'll do is there'll be people like me won't go and buy these 3 sprayers.
Yeah.
They'll start running these, so of course their spare parts might start to go up because of course we start fixing them more, etc. And we start to get used to paying the finance off and taking the depreciation, the repair bill. But then suddenly they don't sell anything. So the other part of their business, so their sales and then their engineers, might not get the work. So you actually start creating the problem.
Yeah, no, it's it'd be interesting to see how that plays out over the next 12 months, 12 to 18 months, I think the other thing we've noticed, James, more recently is the need for more seasonality in structures as well. I think that seasonality could be cash flow linked. It could be weather linked. We've seen a lot of businesses now, not necessarily just ag, but other industries where the seasonalities are far more extreme than they have been for the previous decades, and the need to make sure that the finance is structured in a way that mimics that seasonality. So,
just explain, sorry, because I'm not clear. So take my farming business. I've got my harvest.
Yeah.
I've got quiet, say, over Christmas.
Yes.
I get busy again in spring.
Yeah.
And then obviously it's harvest again. So I've got these sort of very big, intense periods, and I've got these quiet periods. So are you suggesting that cash flow might be slower in some months, so actually you can pay more some quarters and less others? Is that what you're saying?
Yeah, I guess agriculture is relatively well versed in annual payments, if you like, and that's some form of alternative structure. But if you looked at your 12-month trading activities and noticed that your cash flow is really strong at periods, and then there's a period where it isn't particularly great and it sort of ebbs and flows, then we can creatively structure a repayment model that mimics that. So that when there are times where cash flow is buoyant, then you pay more back, and in times where it's quieter or not so strong, you pay less for the machine.
Okay.
And it's just trying to design it so that it suits your business. There's not
is this
really
on the back of COVID, or is this already in place? Because I know there was HP agreements which were paused, etc. Is this where is there a change in attitude from the lenders?
To be honest with you, I think this is the alternative to bank marketplace of funders. That's creating points of difference.
Okay.
It's been able to say, look, we might not be as cheap as the high street bank, but what we can do is create more creative.
Okay, so you're going to pay for the flexibility.
So it'll be a little bit more expensive,
Okay.
those types of solutions, because it's there's a lot more administration in that type of contract. But I guess it's just that educational piece, right? Is that if cash flow is something that at the moment is everyone's thinking about having one eye on over the next sort of couple of years with everything that's going on in the background, is making investments like new machinery could be done in a different way to what has been done as standard.
But I'm assuming that's part of the role of the broker, is that they're talking to the farmer, for example, in this instant, explaining, and then you're putting proposals forward based on what they've told you, or are you looking at their accounts and seeing in a cash flow? Because I'm assuming if I wanted to get finance from you, what are you going to ask from me? What paperwork do you need to see from me?
I mean, look, we just need to understand your financial performance. So, accounts, management accounts, we might need that. We certainly will need that. So effectively, just looking at the general financial health of the business and making sure debt can be serviced.
You're going to want to see my bank account?
Yeah, we would likely want to see bank statement activity, just to make sure that it's a healthy activity.
So, I mean, that there's a hesitation, isn't there? You're almost seeing everything.
Yeah, it can perhaps feel quite intrusive. But, naturally, if we're lending quite a lot of money against machinery and equipment, or it might not be asset finance, we just need to make sure that there is a level of DD done on you as a covenant, and that the business can.
Because you are lending not just only to a limited company like myself.
Yeah.
You are lending to partnerships. I'm assuming you're lending to individuals, sole traders.
Sole traders, partnerships, yeah.
So, I mean, within my business, because of the debt I have for buying land and various other things, we are doing management accounts, and we have got the structure. Yeah. So some of the things you just mentioned aren't necessarily a big problem for me, because we have to do them as part of the covenants on the bank.
Yeah.
But actually, to other people, or when I first started, perhaps that information wouldn't be available.
Yeah, certainly. I think it also comes down to how much you're borrowing. And just the complexity of what you're looking for. If someone's looking to buy a relatively straightforward machine for small debt quantum compared to the size of their business, then the requirement for information will become less. But if we're looking for quite a sizable asset refinance to raise cash to fund your shed of dreams, then we might need more information, because we've got a lot more work to get to that answer. It's all relative to the size of the opportunity, really.
Because I know one of the questions that came in was about first generation farmers.
Yeah.
And they might historically, or it might be somebody who hasn't actually started yet.
Yeah.
And has got an idea, for whatever reason, they want to go into farming in some capacity.
First-hand success stories with new start agricultural businesses over the years, and the principles of lending are: Can you repay me? And how can you provide me some evidence that you can repay me? And am I secure on what I'm lending against?
So they might have a contract.
Correct.
So a tenancy or a contract farming agreement.
Correct. Correct. So where we've got limited time trading, so we haven't got 3 years of accounts to hang our hat on in terms of gaining comfort, but that agricultural contractor that's been trading for 6 months and has been having to hire a machine in because the perception is that they can't borrow money to buy a machine. Actually, they've got a good contract. The machine is being purchased well. It's a used machine, so the depreciation started to shallow out already. They've managed to, they've got some deposit money as well. Typically speaking, that is a fundable customer, and we have got no end of success stories where that type of agricultural business is fundable because we've got good security in the machine, and we've got very evident income streams through the purchase of the machine. At the end of the day, the machine is income generating by default. So as long as we can evidence that as a broker to a funder, that type of business is fundable. And I think that's the misconception, is that I have to hire a machine in for 3 years until I've got 3 years books before I can do anything. That's not how it is nowadays. So I think that hopefully can give, especially people that view your channel that may be in that category of business,
want to have a go,
some confidence and some reassurances to explore it.
Because certainly from my experience, when I started in 2003, if, for example, Peter Cottage hadn't managed to put together an ability for me to get going, I would have struggled. So everything I did from day one was financed. And actually, I hadn't got any income at the beginning, so we had to delay the first payments for 3 months until I got some income in. And anyway, I couldn't go out and buy the flashiest John Deere tractor at the time. We were all John Deere then. I had to, buy old stuff and etc. and then slowly build up. And it worked, and it got me started. And I think anybody that wants to have a crack at farming should try. I mean, but what happens when the wheels fall off?
What happens when the wheels fall off? Well, I think the access, the use of finance when it comes to machinery, there's always an element of comfort knowing that what you're liable to repay is secured against a machine that in theory can be sold. So I think buying machinery well, with where you've got something that has we talk about depreciation, I think that's always something that I'd be really mindful of buying a machine, especially if I'm securing debt against it, so that I've always got sort of a disposal route if I need to reduce.
Because I've just explained the scenario I'm in, and I'll get through that. I'll find a way. But actually, if you're first generation, first starter, you've got to be really sure. You've got a backout plan if something goes wrong.
And I think that's always the reason why people, the examples I've just given, when they're sub-hiring, if the contract for whatever reason falls over,
they send it away.
Back.
Yeah.
So
they're paying a big premium for the hire, though, aren't they?
They are. I mean, the general rule of thumb is what it costs you for 2 weeks of hire is probably what it costs you for a month on HP. So that is a huge impact on your profitability, general profitability. So, but then the offset is
no repair bills.
And I can hand it back if my contract falls over. So it's that weighing up. So the agriculture business has to have confidence in the longevity of what they're going into. Certainly, but that's the risk.
Would you have to be a personal guarantor? If, for example, you set up a limited company from scratch, would that one person being obviously the shareholder, they'd have to be a personal guarantor?
Almost certainly, Okay. I think
so. They've got to be mindful of that. It's not just don't worry, I'm going to let it go bust and wander off. You've got to pay back your 100 grand or whatever it is, and then sell the machine and the difference.
I think you've got to appreciate if we're lending money to a business that hasn't got any substance, hasn't got any balance sheet value really, hasn't got any trading activity. We're effectively lending to you as a business owner. So the principle of a personal guarantee is pretty much is expected for at least businesses trading up to less than 3 years old. So if a business has been trading for 3 years or longer. And then over the course of those 3 years, the balance sheet is strong and the business can stand on its own 2 feet in terms of holding debt, then PG is not necessarily always required. But sub 3 years trading, typically speaking, they're required.
I remember when I was only twice have I done a balloon payment in my career. And the reason I haven't been a fan is because when I was at college, the first college I went to, which was Lackham down in Wiltshire, I always wanted, as all young men do, a better car. And I had this little old 1.3 Golf or whatever it was at the time. And it was a great car, but there was always somebody who had a more exciting car. And, I wanted the GTI. Anyway, people went out and they bought some nicer cars, especially if they had a year out and they'd earned some money, then they bought a nice car. Anyway, one particular guy, he had a balloon payment. Anyway, he couldn't keep up with his monthly payments on the finance. And that's when I really sort of come across finance. This is in the early 90s, 93, 94. And he had to sell the car, but he was still paying for finance for the phantom car in the car park that didn't exist because there was still outstanding balance. And because he had a balloon payment. So I always remember that, and I'd never wanted to have a balloon. And twice I fell into the trap. The first time I was convinced that historical values were as such, and of course when I got to the end of the 5 years, for example, it was on a combine. It was on number 2 combine. It was when I was expanding. I actually had to refinance it because it was the only way I could get out of the balloon, because there was 90 grand balloon, for example, but the combine was only worth 60. I don't know. Yeah. And so I had to go for another couple of years to resolve the imbalance. And the second time I did it, I had a guaranteed buyback on the value, and that's solved it. But you're only actually avoiding the capital, but the interest on that money you still got to pay.
Well, that's it. I mean, I think when it comes to all these different structures, there's no one rule fits all for everybody, right? With all these different ways and you can structure. All your offsetting, all the discussion you're having with yourself is cash flow versus cost.
Yeah.
Okay. If you're borrowing money, there's a cost to it. Of course, there is. If you borrow over 12 months or 60 months, you're paying more for borrowing it for longer. So, but the downside to that is the cash flow impact. So the reason why people look at balloon structures, which is just deferred capital, you're deferring a lump of capital to the end.
Yeah.
Is you're not repaying the capital as quickly as you would do if it is fully amortizing. So ultimately, it's costing you more interest.
Yes.
So it is a more expensive solution, but for certain business types, they might see more operational benefit in seeing the cash flow impact of having a lower commitment.
And it enables you to sometimes have a better machine than perhaps you could rightly afford, you could argue.
Correct.
Or justify at that time.
Yeah, and it might just mean that your business operates at a model where you need to maximise your operating margins. So if you've got a fixed monthly, I think where we saw it a lot, perhaps off the back of COVID and off the back of the last sort of 3 or 4 or 5 years, is there are so many variables in sort of the total cost of ownership of an asset. Labour goes up, labour costs go up, energy costs go up. So all of a sudden, all these variables in keeping a machine working, there's so many variable elements to it. So if there's one element of that machine ownership that you can keep constant is the finance payment, businesses might decide to put that at the lowest possible point to offset some of these other variable costs. Yeah. But they're ultimately paying more interest for the privilege of that. They're also running a slight risk that if the depreciation out-accelerates the repayment, that they could be in a situation that you found yourself in. But the balloon can be set broadly at a level that you're comfortable with. The lender will always give a maximum balloon appraisal. But if you said, I don't like that 90k balloon feels a bit rich after that period of time. I want to have the benefit of deferred capital because I want a little bit less to pay each month. But I'll set that balloon at 50, please. So that you could then get to the end of your term knowing it's worth 60, but you've still got some headroom, but you've still had the cash flow benefits in life. So the conversation you're always having with businesses is we can structure this in so many different ways, but the conversation we're ultimately having is balancing it, whether you're looking to try and achieve cash flow benefits or just ultimately the cheapest cost of borrowing, because you're not going to get both.
And your attitude to risk.
And your attitude to risk.
And exactly. I've even though I've borrowed a lot of money in my time, but I've always been quite cautious on how it's structured.
Certainly.
So I go for fixed rate instead of variable.
Yeah.
And people have a view on that.
Yeah.
And the reason is, even though you could argue I'm paying more for the fix, because that's how fixed is, I've got this theory about waking up in the morning.
Worrying that it's...
And actually, I would say that my theory is even more well-placed now than it ever was. Because my overdraft, which I took out in a loan rather than an annual overdraft because I wanted to avoid the 1% annual arrangement fee, actually, I locked in on a 10-year term. Had I not done that, my borrowed money today would be 2.5 times what it actually is.
Yeah.
Now, that would shape the business very differently.
That's interesting.
And we've now had a war event, haven't we? We've had COVID, we've had Brexit. Yeah. Actually, when you start to look back at the last 5 years, my goodness.
Yeah.
We have dealt with some serious problems. What's coming, I don't know. But Mr. Trump is making some changes, isn't he? I mean, I woke up this morning and apparently he's taken away the tariffs. And I thought, this is going to filter back. This is going to be quite interesting. In my mind, I was thinking, could be a real opportunity to increase the production of the UK, produce the loyalty towards our own produce on the shelves by minimising what alternatives are available because of the size of the tariffs. And I was thinking, actually, this could be just what the industry needs. And with that, of course, you need the likes of you guys, because if there is an opportunity to put on another 10 or 20% or whatever the growth for your business is, to do that quickly, you need access to capital quite quickly.
Quite quickly, yeah. Yeah.
And finance, for all the different opinions people have on it, does enable you to access additional funds quite quickly and seamlessly.
Yeah.
And if you've got 50 different people you're accessing, not everybody might agree with what you're trying to do, but I would hope that within that pot, somebody buys into the journey.
Certainly. I mean, I do think with the sentiment there is speed, right? If you want to react quickly to things, opportunities that present themselves in any business environment as well as agriculture, if the art of it is executing quickly, and therefore if you need to fund, you need to be able to access that quickly as well. So it's just trying to give businesses the confidence to know what's available to them.
Well, the two things which I think would have hurt my business more than anything over the time would be the speed in the access to capital,
sure,
and making a decision.
Yeah.
And I learnt the decision part when my grain store was falling down around my ears, and it was about the lack of making a decision. Not that I had a problem, but I wasn't making a decision. So I learnt that lesson fairly quickly. And then having the ability to shake somebody's hand and do the deal, or to agree to the venture of business, whatever you're doing, in having, even if I didn't want to borrow money today, is having those conversations with you. So I've already prepped you, one for better word, in you seeing my accounts and seeing whatever structures you want, so that actually suddenly I can ring up and say, look, I want to do these sprayers, and you're already ahead, and I'm not coming at you cold. So having the right partner for me is really important, irrespective, as you said, sometimes you might have to pay for some flexibility. But actually, it's what is that cost of flexibility in not doing it?
And it's the opportunity cost. If you know that you have availability to capital, you have availability to funding, because there's legwork that's been done, up to the point, you'll actively seek opportunity with confidence, and you'll probably look to commit to that with more conviction than you otherwise would do, because you haven't got that anxiety as to how I'm paying for this. So I think if you've got, if my job's to work with businesses to ensure that you've got that, we're going through a process of exploration. How fundable is your business? How available can we make capital to you? Whatever form that looks like in structure, less relevant right now, but just to give you the confidence, so that over the course of the next year, things that do present themselves to you, you can approach those with confidence, knowing that you've got availability to fund those projects if you wish to. I think that's the essence of this, right?
So we just finished up the meeting. Actually had a great discussion. Really pleased Tommy come. It's got my mind thinking about what I'm going to do with the sprayers. You've given me some prices which I'm grateful for. Toby's worked out. So we've grown in numbers. If you're wondering where everybody's just appeared from, while Tom and I were discussing what we were doing, the other guys were having a tour around the farm. Simon took them around having a look, and just wanted to see some of the team that you might, if you're going to ring up, you're going to speak to. So thank you, Tom. Really appreciate the chat.
James,
and I'll have a look at that quote.
Indeed.
And they'll know if it's good, because they'll see some new sprayers turn up. Tom's a fellow Range Rover man, so we've got something in common.
Indeed.
But the good news is Tom and his team are going to come support us at the open day. So anybody who wants to talk finance, meet them, talk about their future plans, either give them a call between now and then, or come and meet them face to face.
Yeah, certainly. I look forward to it. Yeah, it'd be good.
Tuesday evening, had a good day today with Charles and Dean. It turned up to do a thing focused on finance, which hopefully you enjoyed, and given me some direction of where we're going to go in the next purchases. So a couple of things, just an update on what happened with the rejected mills. We've done 10 loads elsewhere to a different mill, and that's going through and all gone back to normal service. We stopped going to that one because I'm just not entertained by it. The grain merchant that's involved actually came out on Monday, went across the heap, which got nearly 2,000 tonnes in it, and speared and checked it, found no ergot, was very happy with the process and what we were doing in our colour sorting, and also in what we were putting on the lorries. So we'll be interested to see what happens there. In regard to a couple of questions come through tyres, thank you from Pete from Tanvic Tyres. He sent me the contact details of an independent tyre examiner. So Neil's coming over the next 7 days. He's going to come down, investigate that tyre, etc., and do a report for me and tell me whether I'm deluded and need to just calm down, or actually whether I've got a good case and need to send it to Bridgestone as an independent person would back up what I believe. So I'll keep you updated on that. I'll be very quiet if I'm found to be wrong. New employees, yes, actually, in the end we took 2 on. We only actually advertised for 1. We had a great turnout on series, etc. 74 in total, so thank you everybody which did apply, and I hope everybody got a letter from me. So we took 2 on in the end, just because we felt that there were some good skills there, and we'll make room for them, and with new opportunities hopefully going forward. So they'll be turning up on the end of February and the beginning of March. So it won't be long until you see their cheery disposition on this channel, one will hope. Also, somebody's asked about land drains. What Tim Sissons and William Wolford said was that in very dry times, the lines of the land drains often start to show up. So they will look back on Google Images to see if they can pick up those land drains, to try and find them on fields. It may be something we've got to start looking at doing over in Bedford, see if we can actually find them. We're finding the outfalls, but not necessarily finding where they go or what they're doing. Apart from, the good news is, we're not getting wet patches in the fields. We've got a couple of wet areas in Lowe's, but we're going to deal with them. We've got some IDB issues where their ditches are overflowing into the fields and flooding it. And we've got a sort of an ongoing battle. I'm going to do a piece on that, actually. When the spring starts to hit us and the conditions, I'll show the effect that that's happening, because I'm concerned about that. Glyn is out there at the moment, ditch digging. He's over towards Ely, getting some water moving there, and nearly finished that. Then we've actually got a footpath which has collapsed down in the village at Dry Drayton, so he's got to go back and rebuild that along the ditch edge, which he'll start doing tomorrow. And crop walking inspector Michael will come out of his winter slumber, and we'll start doing some winter walking soon. Well, he doesn't do a lot of walking, I must tell you. It's all done on quad bikes or motorbikes. There's not a lot of walking going on. That's why he got so portly. Now, he'll no doubt I'll be getting a call about this now, and we'll have to have another weigh-in, because I think I have now got into a new coat, and it was too small for me before I managed to get in. So things are going in the right direction, but he is still ahead of me. Regarding the trucks, a couple of questions on the trucks. I'll do a piece on the trucks, actually, because we do a profitability on the trucks, and they're done weekly, and the drivers get a copy. They're put up in the tea room of showing where they are in terms of how well they performed, and also that then gets reflected in bonuses, which is it's like the old adage: the harder you work, the luckier you get. So we try and reward people on that basis. So I will do a bit on that. And tyres, let's see what the independent tyre guy says. Let's see where I get with Bridgestone, and I'm going to have to make a decision. We're down to 4 tyres out of the 72 when I do my annual purchase. So I've got to make a decision in the next probably 10 days to buy some new tyres. So we'll see what brand we get. On Friday, I've got a different supplier coming to see me and a different tyre manufacturer. So we'll see what they've got to say and see what that financially looks like. As always, thank you for subscribing. Anyone that hasn't, please feel encouraged to do so. Open day. So, I haven't asked Tom before I started this video, but I can guess in my mind. I think we're just over 80% now. He's nodding, so that's a good sign. We're just over 80% booked. So we're under 20%. So in a week, we have nearly sold out, or under a week. So I think that hopefully by Wednesday night, we are completely booked. So if you haven't done it, I suggest you get on it, because once they're gone, they're gone. But and we're really having meetings about how we're going to do it and what we're going to do. So hopefully you're going to have an amazing day, and you're really going to enjoy it, and you're going to come down to see the land of milk and honey. So all the best. Thank you. Bye.